asking when it gets to 80, what happens to the stock market?
Well, I think, first of all, the chart on backwardation is telling us a very clear picture, which is that the market doesn't expect this to continue into the future. My view on energy and oil is that this has been a tactical play by most investors. We've seen huge amounts of inflows into energy ETFs, oil and gas explorers up 70% year to date. But at the end of the day, I don't really think investors are looking to hold this space long term, particularly with the emergence of sustainable as a clear trend. And a few questions around whether crude can go to $100 like we saw post GFC. I don't really think that's the case, but moving above 80, I think will be a pretty negative sign for risk assets. But I don't really see a sustained move above there at this point. But it is a very clear case of supply versus demand, so that can change very quickly.
Thomas, you may not think so, but there are already expectations. Oil could be at 80 in the third quarter, 100 by next year. If you take a look at what happened back in 2008, when oil prices surged, stocks sold off. At what oil price do you see that impact on the stock market?
Well, I think it's certainly lower than what we saw post GFC, particularly given the very sharp contraction and very sharp rebound in terms of economy and in terms of demand post COVID and the opening or the return to economic normalcy. So I think that move is much sharper. I don't see such a long-term trend happening there like we saw post GFC, where that sort of happened over the course of 2 to 3 years. It's happened very, very quickly in 2021. So, I don't expect to see it going towards $100. I'm not a specialist in energy, but I do think somewhere in that 85 range, you'll start to see some concerns with oil exporters and energy importers and oil importers.
Now, tell me, Thomas, with oil at 80, 85, what does that mean for the global economic recovery?
Well, I think the global economic recovery is what's really driving this. So if we continue to see that less pickup in terms of delta variations of COVID cases, return to economic normalcy, then that's going to drive the demand in terms of oil. I don't think it's a case of oil then driving global economic recovery. I mean, I think the question which you asked earlier is what that means for inflation. And that's really a key question. Our view is that in the short term, inflation will be a little bit higher, or at least in the medium term, will be a little bit higher than what the market's pricing in at the moment. But we still think that the Fed are not going to raise interest rates until 2023. So that's really the key at the moment in terms of crude oil leading the inflation picture.
So, I mean, how does that then affect your view of what's happening with the bond market right now and what the bond market is pricing in versus the equity markets? I'm talking from probably a developed market perspective more than anything else.
Well, for us, I mean, the view on bonds hasn't really shifted too much. I mean, we are more overweight equities versus bonds. I mean, for us, there's really only a couple of pockets of areas where investors have shown interest in bonds, mostly because of yield differentials, and that's in Chinese government bonds and policy bank bonds. That's really been the one area that's seen interest and inflows so far this year. The rest, in terms of developed market bonds, we haven't really seen too much interest other than inflation linkers, which is very much tied into what we're talking about at the moment. So for us, it's more about equities and within the fixed income space and the bond space in Chinese government bonds and policy bank bonds, as well as inflation linkers.
You're liking, like you said, China bonds. I mean, how are you factoring in default risk? I mean, even if the defaults don't come fast and furious, when it comes to missed payments, that's suddenly picking up. How are you factoring all of that in?
Well, I mean, that's certainly a risk when it comes to China bonds. I mean, not specifically to China bonds, but all bonds which are yielding over 0%. I mean, you are being compensated by that by getting that 3.1% differential. So I think that's a risk. I don't think it's a contagion risk at this point. And particularly in the Chinese government bond space and the policy bank bond space, that's not so much of an issue. So those are kind of the two areas that we focus on where we're not really seeing that particular single bond sell-off risk.